back and moving on for understanding financial statements. We've talked about the income statement in detail, right? Revenue minus expenses equals net income. We talked about all three of those lines, what revenue was, what the expenses were, and how to determine net income or profit or earnings. Those three terms are all synonyms. They all mean the same thing. Now we're going to move on to the balance sheet, right? The income statement is something intuitively that we all understand, right? You get the money in, you pay your bills, and then what's left over at the end of the month, that's your profit or your net income. And that goes for our personal financial statements and also for business financial statements. The balance sheet's a little less intuitive, but still you know about it. And I'm going to use what I found to be a really compelling metaphor using one asset to understand a balance sheet and all the different elements of it. So the first thing is the balancing part, and this is called the accounting equation. This is the main equation of accounting. As I've said before, the end product of accounting is producing financial statements. So the accounting equation is assets equals liabilities plus equity, right? So what does that mean? Those things have to balance, and that's what the balance sheet shows us. So let's make a balance sheet. A lot of times a balance sheet is done this way, where you're comparing assets to liabilities plus equity. And you have to understand that this side has to equal that side, right? These two things have to equal those. This is really easy to understand if you just take a concept from your personal life, right? Let's say the asset is a car, and the car is worth X amount of dollars, right? Say the car is worth $10,000, right? And how are you going to pay for that car? Well, that's what this side of the balance sheet tells you about. The equity would be your down payment. Say you put down $2,000, right, on the car. How much would your car loan be? Well, it's going to be the difference, right? It's going to be $8,000, right? It's going to be $8,000 because 8 and 2 equal 10, and that equals the asset. So these two things, these two sides here put together are showing you how you fund the asset. Same thing for a house, right? Let's think about if you're going to go buy a house. Say if the house costs, it'd be an order of magnitude more. We're just going to round it up. So say the house costs $100,000. Well, and you're going to put down 20%. Well, 20% of 100,000 is 20,000, right? Well, how much is your mortgage going to be, right? That's the other part of this. It's going to be $80,000. That's your loan. Your mortgage is a loan. And mortgage, interestingly, the word mortgage comes from the French, mort, which means death. It's an engagement until you die, basically, what it's supposed to be. In the United States, they have 30-year mortgages, which is pretty close. Very long-term debt that you take on. So that with a house, and the asset, the value of the asset at the beginning is the sales price, or the purchase price, what you purchase it for. And that's a negotiated price, right? The seller says, oh, I want to sell it for $110,000, and you say, I'll pay $90,000, and then you both settle on $100,000. That defines the price of the asset. It is set by a transaction. Later on, you may be paying into, say, 10 years on, that price no longer is the reality of it, because it may have gone up in price, appreciated, or depreciated in price. A lot of times real estate appreciates. That's why people love real estate, because it continues to go up in price, basically. So say now you think it's worth more, you have to have an appraisal done, and an appraiser comes in, and what their job is to value that asset. And what do? They look at comparable sales in the area, and they have to adjust those sales to say, well, your house has 4 bedrooms and this sale had 3 bedrooms, so we have to adjust for that. Or your house is a little bit bigger than this one, and they divide it by the price that those comparables went, by the size of the house, and get a square footage price. Maybe one house has one more bathroom than the other, and so they have to make those kind of adjustments on the comparable sales, and they have to be in a recent time frame, like in the last 6 months, and in that area, maybe a radius of a mile or 2 miles or 2 kilometers or something like that. And then you take that, and you also look at, the appraiser will look at what would it cost if the house was destroyed to rebuild that house, and look at all the different elements of the cost of that. And that's how they come up with an appraisal price. They triangulate that price off of those different ways of valuing it, and they come up with the appraisal. And then you say, well, say now it's worth $120,000, right? Say that. Now, so where does that extra $20,000 go? Well, the loan stays the same, and that extra $20,000 is going to go into equity, right? So now suddenly your equity would be $40,000. Oh, so that's why, another reason why people like real estate, because you can get appreciation and it goes into your equity, and then you can take a loan against your homeowner's equity if you want, or something too. But your equity is what rises because the loan stays the same. The loan doesn't change. That's why, because the equity is the shareholder or investor or the person putting in the money. They're bearing the risk on the value of this asset going up and down, and so they get the rewards. This is called leverage, right? Leverage, you hear that word a lot. Leverage is simply means how much debt you're putting on an asset, and then all of the appreciation or depreciation, that's the risk, flows to the equity. So the shareholders or the equity holders are the ones that benefit or also get the risk if the asset goes down in price, right? So and you hear about this with the Federal Reserve, right? The central banks, right? If central banks are increasing their balance sheet, what are they doing? They're getting more assets. If they're decreasing their balance sheet, they're taking on less assets, right? So let's look at that. How does the Fed, let's see, the United States Federal Reserve Bank, it could be any central bank, but if they want to increase their balance sheet, they want to affect the economy by putting more money into the economy. The central bank prints money, that's what they do. And how do they inject that money into the economy? Well, they inject that money in by buying bonds, and a lot of times they'll buy treasury bonds from the treasury of that country. In the case of the United States Treasury. And so the transaction is the Fed prints money, and the money goes out, right? And they buy bonds. They buy, in this case, U.S. bonds, and those bonds land on their balance sheet as assets. So that's how, when they say the Fed is increasing its balance sheet, it's injecting money into the economy, making the money supply bigger. And what does that do? That means that there's more money in the economy to do more things, so that they think of that as a way to stimulate the economy. When they want to cool off the economy, what they'll do is the opposite, right? They'll sell the bonds, and that's what they say, they're decreasing their balance sheet, right? So they'll sell their bonds, and the bond buyers pay with money, right, with dollars in this case. That takes money out of the economy, and now it's sequestered at the Fed, and that reduces the Fed's balance sheet by putting more bonds off, taking more bonds off their balance sheet and taking money out of the economy. Taking money out of the economy shrinks the money supply, and then that means there's less money out there, so that will cool off economic activity and sort of cool down the economy. If the Fed thinks, or whatever central bank thinks, the economy might be overstimulated or overheated, that's what they'll do. So that gives you, when you hear these terms, now you have a little bit more of an idea of what these central bankers are doing. And same thing with a company, right? A company is financing their business with equity and liabilities, equity and debt. And the equity comes from shareholders. If you're a shareholder in a company, if you buy assets, buy stocks on one of the stock programs, Robinhood or anything, Charles Schwab, TD Ameritrade, any of those kind of platforms, you then become a shareholder. You become a participant in the equity of the company. You're an owner of the company. The company takes equity and debt and funds their assets, and they're looking for income producing assets, right? They're not looking for assets that are going to appreciate in price as much as assets that are going to throw off a income stream into the future. And that's basically what we're looking at a company when we value it, right? We look at how the assets are used productively to generate income, generate net income, right, from what we see on the on the income statement. And then that money going into the future is called, we'll look at it the next thing, but cash flow, right? And cash flow in year 1, 2, 3, and those numbers, we pull those back into today's dollars, right? Because at a certain interest rate, and then those dollars of cash flow, that is a way to take a present value of a company. So that's what assets do in a company. They're productive assets, they're income generating assets. And that income stream into the future, pulled back to today's dollar by discounting it by an interest rate. And we could talk about that in my finance class. So I just wanted to give you a preview and a taste of how income producing assets value a company. It's the present value of that income stream that is the value, one way to value a company. So there you go. There's assets. The other thing I want to talk about, assets, liabilities, and equity, and a balance sheet. The liabilities and equities fund the assets. And I want to tell you about the template, the format of a balance sheet. Well, the format is, it starts with, there's all the line items of all the assets, right, that a company has. And they go from the most liquid to the least liquid, right? And what do I mean by that? Well, liquidity is another word you hear a lot. And liquidity is how quickly you can use that money to do a transaction. The most liquid asset is cash, right? Because you can just use that to do a transaction right away. So cash is the first asset on the balance sheet. Let me write that in. Cash, right? And then cash equivalents. A lot of times if a company has a lot of cash, they'll put that cash into marketable securities. And so they're getting some sort of return on their cash on the short-term basis. But those marketable securities, you can sell them, say if they're stocks and all, you can sell them when you need to and get the money and use that money to pay your bills, right? Your bills are over here. And then, so you have marketable securities next, and then you have your tangible assets would be your machinery and your trucks and all those kind of things. And then your intangible assets are last, and those would be patents and intellectual property, things like that are down here. And so it goes from the most easily turned into cash down to the least easily turned into cash. So the first one are cash, marketable securities, and then inventory, right? Because your inventory is relatively liquid. The problem is with inventory is you can't just go and dump it all right away and get that cash without having to massively reduce the price of it. So inventory is not really as liquid as cash, but it's more liquid than maybe say your factories and your machinery and all those kind of things, and certainly more liquid than your intangible assets, your trademarks and your patents and your other intellectual property. So that's how the assets are prioritized on the balance sheet. And then liabilities are prioritized in the same way. You have your current liabilities, right, up top, and then after your current liabilities come your long-term liabilities, right? And the long-term liabilities are your debt. Current liabilities are anything that you have to pay within a year. Those go up top. Then your long-term liabilities are your liabilities that you have to pay after that, say 5-year notes or 10-year debt, whatever, that kind of stuff. And then the equity is how much money the shareholders have put into the company, and then also after that, how much additional capital, what we call retained earnings, right? Retained earnings go into the balance sheet in the earnings section, and retained earnings is the net income that doesn't get put out to shareholders as a dividend, but then goes back into the company. It's retained, right? So that money will also be, over years, equity is going to go up by the amount of retained earnings, by amount of that fraction of the net income that goes back into the company. In many growth companies, they don't do a dividend. I don't think Google has a dividend. Apple has a very small dividend. High-tech companies that have big growth prospects, they're not even dividending money out to the shareholders. So the shareholders aren't looking at it as a income-producing asset. They're looking at that those stocks are going to appreciate in value as those companies grow. And so they're plowing all their money back into retained earnings because they have what they consider better growth prospects for that money than if they dividended it out to the shareholders. So that's how a balance sheet works. That's how companies operate with them. And next we'll talk about the cash flow statement. And I'll see you in that video.